Hello guys. Good morning, and thank you for being here. So, I would like to say thank you for the audience and also for Wego and Callum for being here. So, as this session is about crypto market narratives and investors and outlook, so it would be best to start off with the investors. But before that, let's go around and introduce ourselves first. So, my name is Nine. I'm the venture lead at CryptoMine Labs, a venture studio at CryptoMine, and then we'll go around the table and start with Wego first.
Hi guys, morning. This is Wego from Blocktempo, currently the largest Chinese blockchain media in the world, and we actually did like fund investing as well. So we have a parent company called Entropy Group, and Blocktempo is under Entropy Groups, and we also have our venture arm and also our tech labs focusing on the cutting edge technology.
Hi guys, Garland Wan, managing partner at Momentum Six. We're a Web3 venture capital. We also own a research arm called Crypto Illuminati, which I think was one of the largest research channel in the space. And we also own a hiring arm called Illuminati Jobs, which is like matchmaking for people who are looking for jobs versus people who are hiring. So good to be here.
All right, thank you guys for being here. So let's kickstart the session with the first question. So what can we see here is basically it's now the bear market, right? And you guys have been here in the space for quite some time. You've seen the ups and downs, the troughs, the previous bear market. So what has been the biggest difference so far comparing to the 2017 or 2018 market compared to this bear market so far?
Garland, do you want to go first?
I do see like a similarities in terms of very decreased activity. I mean, like I joined in 2017, so my experience back in 2018 bear market versus now is very different. 2018 was I didn't have that much capital. I didn't really see the capital landscape, so I just kind of heard and like kind of like overheard indirectly from people how it was, right? Versus now, where we do actually have capital to deploy, and like we do have to have strategy on terms of like how we think about the whole market. So I think it's similar in a way where it's like the investment dries up, the activity dries up. If you see on Twitter and all that stuff, a lot of things dry up. I do believe that there is significantly more activity in terms of 2018, 2019 versus now. Because like we just had that much talent flow. We had so much more capital flow that come in 2020, 2021, right? So I do feel like like right now it is way more active. There's way more infrastructure. There's way more kind of ecosystem that are built up versus 2018. So I definitely like I see this kind of continuing to a next cycle.
Yeah, I think Garland, we are in the same class, 2017, entering crypto space. So I think the major difference is, I think the previous go around is more a lack of resources. If you want to build up some project or you want to do something in this space, you encounter a lot of challenges. And speaking of like even fundraising, you find it very difficult for you to do the fundraising, even if you have the MVP. But I think right now a lot of people are saying that it's pretty bearish. But if you look at the data, last year a lot of funds they actually raised a ton shit of money, so they have a responsibility to deploy those capital. So for the entrepreneur like us, I think it's the best time to to do your project right now. And for the retail players, we also heard a lot of people saying that crypto opportunities for retail players is gone. That's they only exist in the last cycle. But like from a point of view, that means button is not here. We need more maybe market crash. We need more downside and wipe all the players out. Then we will reach the button. So I think just pretty chill. And the major difference, we have more opportunities right now.
So basically, the opportunities were created due to VC which have raised funds in the bull market, right? And they're obliged to deploy, and they're looking to deploy, right? So it's a great time for founders and a great time for project owners to reach out to VCs and raise funds, right? But what about investors? What do you think would be how do you think it would affect the investors in this time around, like retail investors?
You mean like how would it affect investors?
Yeah, I mean like comparing to because you mentioned Gollum earlier, right? That there's a higher amount of activity compared to the 2018 bear market, right? For example, but what's the difference between as like if you wear the hat of a retail investor, is this time different compared to 2018?
I think for the retail investors, like at this moment, it's pretty friendly. Like take ourselves for example. You know, back in like 5 years ago, if you're doing some crypto startups or you're doing crypto stuffs, and your parents were probably curious about what you're doing because it's hard to explain. And a lot of time when you cash out into the real world, you're holding a bag of cash or something. It's kind of like a drug dealer or something. But I think nowadays the market and the mainstream media has educated the users. So like from the retail perspective, I think it's much more friendly. Even FTX collapse hurting a lot of retail investor, but comparing to the last bull run, it was even crazier. So yeah, I think it's quite friendly for the retail investor right now.
I actually have a different opinion. So I feel like the landscapes have it's continuously growing tougher for retail investors because of the capital that's being deployed and infrastructure that are being built. Like in any kind of sense of, I guess, like whether it's investing, whether it's trading, whether it's building your own project. 2017 was there's no infrastructure. No one knew what the fuck they were doing, so they could just do whatever. Build a website, have a nice design, do an ICO. Invest into ICO. No one had any clue, thesis, whatnot, right? Now it's like we have all these like traditional funds that are very mature and veterans in the like I guess like the market, and they're coming in with their high frequency strategies, their algorithms, their like basically like their the way for them to exploit some of these DeFi, and like the retail investors haven't really gotten that much smarter. Whereas the competition, because at the end of the day, it is PvP. So at the end of the day, you need to have an edge over other entities or other people in order to be able to win in the market, right? And I think this market is significantly harder to win because of how many talents kind of came in and just how much like infra they brought with them, right? So I feel like for retail investors, like they just need to use this time to really just get a lot smarter, or build their own infrastructure, build their own kind of a system that they can have edge over, because crypto as a market is very cyclical, right? And usually in a bull market, you're not trying to learn. You're trying to get output out of the things that you built in the bear market, right? That's kind of like the cycle that we live in. So, this is a time where you need to have your own kind of like edge, and you need to build your own edge in order to kind of survive in the next bull market. Otherwise, like you'll get buried like everyone else. Yeah.
So basically, it's a good time for retail to basically step up their game, right? To combat with the rising competition from the talent flow, which comes in from traditional side of things.
Yeah, I think you should be busier. I should be busier now than bull market, because there is a time arbitrage, right? Like, I mean, I talk to a lot of my peers. I talk to a lot of people that I work with, and a lot of them kind of have like took a vacation, or like have gone away. And I think this is actually the time where you should be busier, because there's less noise. There's a lot more time to get connected with the people that you want to connect with. There's almost like this time arbitrage, right? So you want to make sure that you leverage time as much as possible. You build your team as much as possible, so that in this market you have the when you have the opportunity to take that market share, you capitalize on that opportunity, right? So yeah.
Yeah, I think that segues into the next question quite nicely. As we mentioned, what retailers can do to adapt. And as you guys have participated as VCs as well, so it'll be interesting to hear how is it different for VCs this time, given more competition, given more activity. Has your strategy changed compared to the bull market, and now it's the bear market, right? How has your VC or how has your venture arm adapted and planned for the next bull market?
I think we can separate that into two parts, for the like financial standard point of view. Like the only thing you have to consider before entering the back is how to exit, right? This is the first principle. But we focus on more. We focus on more. The other thing is the entrepreneurs. all the portfolio company we invest in was the founders we met in the previous bear round. So basically, in the bull round, everyone are friends of everyone. You can't tell the difference. You can't tell how bad they are or how good they are because all of them looks pretty good based on the market conditions. But in the bear round, it's totally different because it will test the entrepreneurs. How can they deal with the stress? How can they deal with the product? How to grow? So yeah, we bet huge on the entrepreneurs. We are bullish for.
So there's two things I think that we've been doing differently. So investment side definitely slow down because I think we're relatively new venture, and I think in the bull market our thesis was very different versus bear market because a lot of our thesis kind of was driven around this adoption through token. Whatever you're building, whether you're building AMM, whether you're building an NFT project, whether you're building a GameFi, whether you're building a derivatives option protocol, whatever that is, right? So it was always centered around token-based adoption, and as long as that held true, we were comfortable investing aggressively. Now it's not, right? So now the projects with the capital drying up, with the high interest rates, with the macro as it is, and everyone kind of starting to almost going into this Cold War kind of setting. I think the capital market's going to be drastically different, and we need to change our thesis because the projects that are going to survive aren't the projects that have the biggest vision, that have the best marketing. It's the projects that actually have users, actually have utility, actually can make money to survive through this market, right? So because of that, I think we changed our kind of approach to looking for more, the strong founders who have, lasted through bear market or know how to last through bear market, not blow away, 400, 500K on their salary per year, just dumb things like that, right? So we look for strong founders that have a clear trajectory to revenue model. And instead of doing a token, I think a lot of the VCs have been equity with warrant, token warrant, which token is very liquid, and because it's liquid, it's safer in a bull market, right? But it's very unsafe in a bear market because as soon as they launch, the token, you're kind of exposed to that downfall, right? So equity, in a sense, is very illiquid, right? So if you have that option for equity as well as token, I think that's what a lot of the VCs are kind of looking for. So that's the investment side, slowing down a lot more, looking for founders that are revenue and more of user driven rather than vision driven, and then looking for founders changing the approach from token to kind of a more equity with token orient. So that's one. And then second thing is like I said, we've been actually growing our team. We've been growing the things that we can do on our end. We've been building our research arm. We've been building various different things that are on the back end right now that we haven't really shown. We have been trying to find value add materials. Things we just built out this job board or job matching system after the FTX thing kind of happened, right? And everyone was like kind of like going through a tough time, and then a lot of people started looking for jobs, and there were always like guys like us that were hiring. So we wanted to create something that can connect, like match that more easily for people. So yeah, like in terms of teams, and we're aggressively hiring, we're aggressively growing because we feel that this is a really good opportunity for us to capture a significant amount of market share while everyone is in a coma or like sleeping, right? So that's how we kind of see the current market trajectory right now. Yeah.
I think you mentioned a few interesting points that I would like to highlight to the audience, in that VCs right now are looking for traction-based projects, right? They're not just looking for to back their vision. They're looking for projects who has proven that their vision be able to be executed, and basically the total addressable market is there for them to go out and penetrate, and also to look for strong founders, battle-tested founders who has been through the ups and downs of the market, just to see that they can actually make it through to the next bull market, right? And to that point, I think you mentioned about your thesis changing, right? So it would be interesting to hear as well on which narratives or which sectors you think will still come back in the bull market. For example, will DeFi lead the wave? Will it be gaming, or will it be like a Metaverse related project? What do you guys think?
So we had, yeah, there were a couple of things that, I mean, like I could go into the whole thesis, but I'll just mention a couple of them that are more recent. So I think with the whole FTX blow up, as well as like the most prominent lenders like Genesis, and like a lot of these funds, 3AC, and like a lot of these guys that we thought were geniuses blowing up, I think is going to change the market dynamics and market structure quite a bit. And I think the way it's gonna change is because we had all these like big monopolized centralized parties that are like in charge of lending, in charge of borrowing, in charge of kind of like creating yields like Celsius, whatnot, right? I don't think that's healthy, because at the end of the day, the market, the size of the market isn't really ready for that kind of monopolization, I don't think. Because like as you've seen, like Celsius, 3AC, Genesis, all of these guys, like if you ask the yield, where the yield's coming from, they always say, oh, it's the guy that we lend it to, and it eventually becomes a very small circle that there's like 5 guys that are lending to each other, and once one of them blows up, everything blows up with it, right? So I don't think that's a very healthy model. As also with the FTX blow up, like a lot of people kind of like lost their life savings, and it's not the retail, it's $20 million, $50 million, $200 million hedge funds and market makers, and like it's the guys who provide credit to the industry, right? So because of that, I think it's gonna set the industry back quite a bit. And thesis kind of like changing from that is, I think the crypto market, instead of having these like mega giant players that are doing all these lending, custody, like monopolizing, like FTX. FTX did, they were a bank, they were an exchange, they were a market maker, they were a hedge fund, they were a venture capital, like they had everything, right? So I don't think that's healthy for the industry, because there's just copious amount of conflict of interest that happens. So I think because of that, it's going to be more scattered, custodians and kind of middle layer like OEMS systems, or execution brokerage that allow you to execute your orders from like your individual wallets or sovereign custody. And it's gonna look more like an FX kind of market, where you have these like scattered players that are all participating in the same market without being interdependent, right? So the collateral is all separated, right? You have different players bring in different collaterals, different fund sources, but you all participate in the same market, right? So that way, you actually get more liquidity, and reduce the risk of like one centralized party failing and wiping 30% of the liquidity out of the market, right? So that's one of the big things that we've been kind of looking at, and we've kind of like started to look into more people that are doing custodies, more people that are doing middle layers of like kind of like something that replicates like a OEMS system or order management system, the brokerage, things like that that can kind of like glue those systems together. So that's one of the things that we've been kind of looking at now.
Like from my point of view, it's a little bit different. Like speaking of thesis or narratives, I think that's kind of like the capital-driven stuffs. Like currently, we are more focusing on the application layer side. Focusing on the data, focusing on the user space. For example, I think it's not about maybe DeFi next year. DeFi will come back, or GameFi will come back, or some narratives will come back. I think one of the major like key indicator is that if there's a lot of users gathering in one space, there's definitely opportunity, right? For example, like Binance or some CEX. Like I would say like 90% or even 80% of the whole like revenue in this industry was driven by them, right? Was generated by them. So I kind of feel like in the future, the more users you can gather, the more opportunities you have. And either you're a Web2 company, for example, like Telegram integrating Tong blockchain, or you're a Web3 native project like Zappen, and you can gather a lot of users in a short time, then you can find the opportunities to survive. That's what I think is very interesting right now.
So I actually have a theory on this, and I think it kind of works with like a human model as well, like country model. Basically, when the country is growing, where from a let's say third world country to first world country, democracy doesn't work that well because you need action, right? You need very swift decision making. You need more of a centralized decision making that allows you to move fast and do things that are maybe not the most popular to the public, right? That's how you get out of that system, right? And you've seen with a lot of third world countries that kind of came out of poverty and come into more of a first world country standing, right? I'm not gonna name any countries, but because of that, like when it's early, when it's like 2017 crypto, 2014 crypto, dictatorship or centralized decision making works really well, and that's what we had so far, right? I think at this point we have become mature enough that we need to be on more of a democracy level where there are multiple players making that decision. There are DAOs, there are multiple different players that are not so centralized, not monopolizing everything, that work in their own space for the good of the system, and that's how a lot of these first countries kind of work, right? Because at a certain point of development, the dictatorship model doesn't work because the education and the quality of the talent that you have inside the country or an ecosystem like crypto goes up, and it's hard for one dictator to kind of control all of that talent, right? So I feel like we're at a kind of like moment in time where we are shifting from more of like monopolize like these giants that are taking over every aspect of industry to people who are kind of more decentralized, more scattered kind of like geniuses and ecosystem players that kind of start building their own ecosystem and then growing the whole pie together. So that's the thesis that we have as a VC, kind of like looking in the space. Yeah.
So it's like a turning point of an industry from moving from an era of quick monopolistic action to an era of democracy and also leaving the decision to the masses, right? As you said, opening up to more stakeholders and allowing different people to help shape the industry, right? And I think it's also interesting, Vigo, that you mentioned about consumer-facing applications, and Column, you are focused on more of the infrastructure, the enablers, the projects which enable and act as the middle layer between the consumer-facing applications and the layers, right? And to that point, I think as you guys have different takes and different appetite for projects, right? As what happens to retail investors as we see in the bull market, right? Retail investors will basically following VC money. Wherever VCs invest, they go invest. So how would still retail investors adapt to this? Should they still follow VCs, or how should they look at portfolios in VC, and what should they think and what should they take away from the investments VC make?
I think one of the most beautiful thing in this industry is we saw a lot of retail investors actually outperform notable VCs. And if you're a retail investor, it's very easy for you to directly invest in a project in this industry, like via USDC and SFE form or SFT, like SAFT. But if you're in some Web2 space, I think there will be a huge applications for you to find the hidden gem. The cost of finding that would be super high. But I think in crypto space, retail investor actually got the privilege to find the hidden gem, and they are capable of competing with those VCs. So yeah, that's my point of view.
No, I agree with Wego on this. So I think the question was like, should retail follow VCs? So VC, I don't know how many people like kind of know how the VC model works, but a lot of the LP funded VCs, they usually have a certain number of years where they need to deploy that capital, right? So whether that's like 4 years, 5 years, 6 years, sometimes as short as 2 years, 3 years. So like these guys raise money and they are obligated to deploy money within that period, which means that they might be making decisions not the interest of quality, but interest time, right? So they're forced to make those decisions, right? Retail investors don't have that, right? They don't have that obligation, which means that they can take their time when it's when they see a project that they feel like it's not up to the quality, they can always like back out, right? And also, I think with this FTX and everything else that's been happening, we're realizing that a lot of these big VCs don't really have idea what they're doing, right? We don't either. Like I'm not gonna say like we have complete faith in like whatever our thesis is, and like our thesis is that it's like airtight 100%, right? Like I think it's just like everyone is, especially in a place like Web3 where information and everything is so accessible, I think you have the ability to learn to a point where you can do better due diligence than the VC, right? So I think as long as you're doing your research, as long as you're like in there, putting in the hours. Obviously, if you're not willing to put in the hours, if you're not willing to put in the research, if you're not willing to put in the work, then yeah, sure, follow the VC. And if you get wrecked, that's your fault because you didn't do your diligence, right? The only due diligence you did was to follow, like which VC was in the round and follow that token, right? You clearly didn't do your diligence. So, if that's your choice of investing, then yeah, sure. But I think retail investors and like whoever's kind of investing, right, should treat themselves as like individual VCs. Everyone who's investing should almost have that magnitude of like, yeah, like I'm not just a retail, like I'm a participant in this ecosystem, right? And whatever I invest in, I invest with the same gravitas or the same weight as like the VC. That way, I think you get to kind of like have your own thesis and thinking, and you're more inclined to be successful in the future rather than just follow along. Because if you're just following along, you're not really adding value. You're just adding capital that potentially might go to a harmful project or shit coins,
It's
right?
basically
So,
gambling.
what's that?
It's basically gambling.
Yeah. So yeah.
Yeah, I really agree with how you put it, Galam, in saying that retail investors should position themselves as participants, right, and not necessarily copy trading VCs or following what VCs were doing. It might be a good heuristic to basically use VCs as a basic due diligence screening period, but at the end of the day, they have to do their own research, they have to do their own analysis, and so that they can learn from it, but also to actually make investments and actually profit from it. As you guys say that retail investors can actually outperform VCs due to the constraints VC have, whether it's fund life, whether it's the obligation to deploy, whether it's the lockup period, right? And I think to that point, before we conclude the session, because we're running out of time, right? So I think we guess for you guys to leave something for the audience. Do you guys have anything to say about yourselves? Or?
Yeah, I think speaking of the previous conversation, because every time when we talked about the retail, right, we actually put some negative point of view on the world of retail, but actually in this industry, retail has a lot of advantages. Like just for example, as Garland just say, you don't have the time pressure, right? You can deploy your capital or deploy your efforts anytime, anything you want or anything you don't want. So you don't have to be pushed by anyone. So it's quite a huge, I would say it's quite a huge flex. Yeah.
Yeah, so I do think in this market, what I want to say is the thing that I think I really am proud of myself for in 2018 and 2019 is that I didn't leave this industry. I kept going, like I blew up my account several times, built it up and blew up to like zeroed in, several times in my life. And each time that I was zeroed, I didn't leave. I, try to find new jobs. I try to find someone that will work with me in the industry. And I think that really paid off on the last cycle, 2020, 2021, because the network and the infrastructure and the value add and the skill set that I built up in 2018, 2019, being involved with those, projects and VCs and whatnot, really helped me to get a head start over other people. And a lot of my peers that started with me in 2017 left, and they came back in almost at the end of the cycle in 2021, and they weren't able to capitalize on the opportunity that like as much as like we could. So I would like advise everyone to really take this time to build your network, build your skill set, build your quality, and next cycle comes, and it always does, it always will. You'll be able to kind of capitalize on opportunities. So yeah.
So that's a great way to wrap it up, Kam. So I think we ran out of time, so we'll be concluding this session. So thank you, both Wego and Kalam, for coming up here, and I hope this was helpful to the audience. If you guys have any questions, you can catch them around the event, right? So yeah, we'll be around. All right, thank you guys.